Welcome to today's Explainer. Let's dive right into something that is honestly incredibly frustrating and totally counterintuitive for a lot of us. We're looking at this bizarre reality where absolute catastrophic global conflict headlines hit the news, the kind of stuff that makes you just want to stuff your cash under a mattress. And then, almost immediately, the stock market just rips to all-time highs. It seriously feels like a glitch in the matrix, right? But as we're going to see, it's actually a highly engineered reaction. I mean, it's the ultimate paradox for retail investors. You flip on the news, things look incredibly grim, yet somehow your portfolio is just flashing bright green. To put that into perspective, the S&P 500 has literally surged more than 60% since the Russia-Ukraine conflict kicked off back in 2022. It totally defies basic human logic. We naturally assume global instability equals market panic, but the actual numbers, they tell a completely different story. Now, whenever these surges happen during conflicts, the traditional financial media loves to slap this simple label on them. They call them relief rallies, pushing this narrative that the market is just celebrating the mere possibility of peace or de-escalation. But our sources show the truth is entirely mechanical, and it's mostly hidden right beneath the surface. It is not about the market feeling optimistic. It's about the market being forced to act. Okay, so before we get to those hidden mechanics, we definitely have to acknowledge the traditional fundamentals at play here. During recent conflicts, underlying economic factors have actually provided a nice cushion. You've got long-term corporate earnings staying incredibly resilient. Plus, when Brent crude oil falls back down to around $99 a barrel, that obviously lowers inflation expectations. Throw in strong support from domestic institutional investors, or DIIs, stepping up to buy, and you've got a pretty solid foundational layer holding up valuations, despite all those scary headlines. But here's where it gets wild. Think back 20 years ago. We had a human market. It was dominated by portfolio managers actually reading earnings reports and analyzing cash flows to figure out what a company was worth. Well, today, that market is basically gone. We are now operating in a machine market. It's this massive, complex engine driven almost entirely by algorithms, passive index funds, and automatic hair trigger reactions. Because of this massive shift to a machine-driven landscape, when unexpected news hits the market today, it triggers a very specific chain reaction of forced buying. It's basically a sequence of 3 dominoes that act as one giant feedback loop. So, to really understand why the market rips upward during geopolitical crises, we need to unpack these 3 dominoes: the hedge fund short squeeze, the algorithm flips, and options dealer hedging. Let's start with domino 1, the short squeeze. Going into recent conflicts, professional sentiment was actually incredibly bearish. Hedge funds were panicking, holding their highest short exposure to macro ETFs, things like the SPY and QQQ, since the 2020 pandemic. But here's the catch. When the market doesn't crash like they expected, and instead gets even a slight bump, a short squeeze kicks off. You know the drill. When you short a stock, you borrow shares to sell them, hoping you can buy them back cheaper later. If the price goes up, instead, brokers start issuing margin calls. Suddenly, these sweaty, over-leveraged hedge funds are forced into a frantic scramble to buy back shares at a higher price just to close their positions. And guess what? All that forced buying pushes the price up even higher. Which brings us to domino 2, algorithm flips. This domino is all about commodity trading advisors, or CTAs. These are massive systematic trading firms running strictly on mechanical models. They literally do not care about the news. They ignore geopolitics completely and just follow mathematical trends. Going into the ceasefire news, these CTAs were sitting on massive short positions. But as that first domino, the short squeeze started pushing prices up, algorithmic triggers were crossed. These robots were instantly forced to flip from short to long, mechanically buying a staggering $86 billion in equities over just 5 trading sessions. Seriously, to put that $86 billion into perspective for a second, this violent algorithmic pivot was one of the top 5 fastest buying frenzies in Wall Street history. It is an absolutely astronomical amount of capital slamming into the market all at once, violently accelerating the momentum that the initial short squeeze created. And finally, the last piece of the puzzle. Domino 3, options hedging. This brings us to the frantic options market dealers. By the very law of their own risk management, they have to constantly buy and sell underlying stocks to keep their massive trading books perfectly balanced. Heading into crisis periods, these dealers often find themselves in what's called a negative gamma regime. In plain English, it means that as stock prices go up from those short squeezes and algorithm flips we just talked about, these dealers are mathematically forced to buy even more stock just to maintain their balance. They're essentially pouring high-octane gasoline directly onto the fire. Now, all of this intense forest buying chaos is happening in a landscape where actual active stock picking is in the minority. Look at this breakdown. 63% of US stock funds, which represents over $13 trillion, are now held by passive indexers. This is quite literally blind money on autopilot. It doesn't read the news, it just automatically allocates based on market cap. So as the dominoes push the biggest stocks higher, passive funds automatically buy more of them, reinforcing the entire cycle.
And underneath all of that, the velocity of the options market has just gone completely into overdrive. Same-day expiration options now make up 63% of all S&P trading. On peak days, we're seeing over $2 trillion of notional value changing hands. Every single one of those options forces a dealer to hedge in real time, completely amplifying the wild mechanical swings of the market.
So, when you put it all together, what are we actually left with? Well, it's definitely not a market primarily concerned with analyzing long-term valuations during a war. No, it is a machine made up of algorithms, passive funds, and options dealers aggressively reacting to one another in real time. The headlines we read are honestly often just the narratives we humans use to rationalize the mechanical feedback loop that's actually driving the prices. So, investor strategy, how you should react to all this. Understanding this hidden machinery should completely change your strategy. Because the market is this chaotic mechanical chain reaction, emotional human panic selling during scary headlines is quite literally the worst possible trap you can fall into. As Naveen Malwal from Fidelity sharply points out, negative headlines can persist for a really long time. If you sell and wait on the sidelines for the news to finally look good, you've almost certainly missed the most violent, profitable days of the rally, because those days are driven by sudden, mechanical dominoes falling, not by world peace actually being achieved. And the cost of that emotional timing is absolutely massive. Data going all the way back to 1988 shows that if you had tried to time the market and missed just the 5 best single trading days, which, by the way, frequently occur during periods of intense geopolitical stress, your long-term gains would have been slashed by a massive 37%. So how do we actually survive this? Honestly, the timeless advice holds true, but for entirely new reasons today. You pursue peace of mind through broad diversification. You stick relentlessly to your long-term plan, you ignore those ominous daily headlines, and you just let the underlying fundamentals, like stable oil prices and domestic liquidity, do their job. Don't try to outsmart a market that is literally driven by robots flipping switches. Take a hard look at your strategy today. When the next scary headline drops, and the hedge funds get squeezed, and the algorithms flip, and those options dealers start frantically hedging, are you prepared to stay the course? Or are you still trading like a human in a world run by machines? Thanks so much for joining me on this explainer. I really hope this completely changes how you look at the news and the markets.